Over the last 12 months, stablecoin issuers have quietly become meaningful buyers of US Treasury bills. At the same time, digital asset firms such as Circle and Ripple have moved inside the US banking system with bank-style approvals. Now, put those two facts together and something really important changes, because treasuries are how the state funds itself, and bank charters are how the state decides who it allows to handle money at scale. This isn't a crypto story. It's a balance sheet story. What's happening here has nothing to do with ideology. It isn't about beliefs, it isn't about crypto versus the banks, and it certainly isn't about tokens. It's about size. Stablecoin issuers now manage tens of billions of dollars. Not theoretical dollars, actual obligations. And once your balance sheet reaches that size, three things matter, and only three things. Liquidity, time, and permission. Treasuries provide liquidity and time. Bank approvals provide permission. That combination is what counts. When firms that mint digital dollars are pulled inside the banking perimeter, the system isn't experimenting anymore, it's adjusting. Circle and Ripple didn't arrive here by accident. Not because of branding, not because of community, and not because regulators suddenly fell in love with crypto. They're here because they already operate at scale. They already move dollars across borders. They already sit inside settlement flows. They already touch the government bond market. The license didn't create that reality, it reorganized it. So it's worth being clear about what a national trust bank charter actually means. It does not mean retail banking. There are no branches, no deposits spaced, no mortgage books. What it means is simpler and more powerful. You're allowed to hold assets under federal supervision. You're allowed to operate nationally. You're allowed to sit where settlement happens and collateral matters. That is where influence lives in modern financial markets. Now, for years, digital finance was kept at arm's length, forced through correspondent banks, fragmented by state licenses, pushed offshore, and surrounded by friction. That wasn't an accident. It was a system protecting itself. But friction only works when volumes are small. Once liquidity reaches scale, blocking it doesn't reduce risk, it concentrates it. So the strategy changes. The system stops pushing it back and starts pulling it in. That's what these licenses actually represent. Digital liquidity is no longer circulating the financial system. It's being brought inside. It's being watched, it's being measured, it's being stress tested. And once that happens, a far more practical question starts to appear. Where does this liquidity go when it needs to actually do something useful? And the answer to that is very, very simple. It's the commodities market. Liquidity doesn't really care about narratives. It doesn't read white papers, it doesn't attend conferences, and it doesn't argue on panels. Liquidity goes where it can move, earn, and exit. That's why commodity matters. Every cargo crossing the ocean is a short-term loan. Every shipment is a funding bridge. Every trade lives between production, transport, and payment. And here's the part that many people miss. Commodity markets don't break because prices move. They break when funding doesn't arrive on time, settlement delays, cash gaps, time mismatching. That is the friction that kills trades. And that's exactly what digital liquidity is designed to fix. Now, stablecoins were built to settle instantly, to move across borders, to remain live when banks are closed. And for a long time, that capability was trapped inside the crypto market. Now, it isn't. Because once liquidity is regulated and allowed to scale, it stops behaving like venture capital and starts behaving like working capital. And working capital doesn't chase hype, it chases flow. This doesn't mean banks disappear, not by any means. It means exclusivity disappears. You get parallel rails, faster settlement, more flexible collateral, funding that doesn't shut down at 5 p.m. New York or wait 2 days for a confirmation. Because in the commodities market, optionality isn't a luxury, it's survival. Now, step back a minute here. The United States doesn't have a crypto problem right now, even though it's much reported that it does. What it does actually have, it has a debt problem. Treasury issuance continues to grow, but buyers must be found, so the system adapts. Stablecoin issuer becomes treasury buyers. Banks are encouraged to hold more duration. Rules adjust, boundaries shift. And when digital firms receive bank-style licenses, they don't just buy the government debt, they become part of the machinery that funds it. Digital finance stops pressing against the system from the outside and starts operating from the inside. Now here's the irony. The same digital liquidity helps absorb government debt is now flowing into commodities, the very assets people turn to when debts become very, very uncomfortable. And I'm talking about oil, metals, energy, food. This isn't disruption, it's the system looping back on itself. And none of this arrived with a press conference. And there were no slogans, no victory laps. It happened quietly. Stablecoins bought treasuries. Licenses were granted. Settlement power shifted. And suddenly the system that once dismissed crypto is supervising it, licensing it, and absolutely relying on it. Now that should make people pause, shouldn't it? Because this isn't innovation winning. It's scale, forcing acceptance. The biggest financial shifts never arrive with an applause. They arrive quietly. And then, much later, everyone else realizes they happened a long time ago.